All right, let's dive right into this explainer. Today, we're unpacking a highly debated topic straight from the CFA Level 1 equity module, the true mechanics of strategic share buybacks. Because let's face it, if you've ever wondered why massive corporations are dropping billions to buy their own stock, instead of, actually investing it back into the business, you are in the exact right place. We're kicking things off by completely shattering a common retail investor myth. Senior CFA Amin really hit the nail on the head with this core principle. Buybacks do not magically create value. They redistribute it. Seriously, it's not magic, it's just pure structural mechanics. And depending on how it's executed, that redistribution can either be a massive win for you or a total value destroyer.
So here's our game plan for today. We'll cover the core principle, break down the actual financial math, look at some billion-dollar real-world cases, compare buybacks to dividends and their risks, and then wrap up with some serious pro tips and practice questions.
Okay, let's jump straight into part 1, the core principle.
This right here is absolutely crucial. Buying undervalued stock benefits the remaining shareholders, but overpaying literally destroys intrinsic value. Think about it. If a company's true intrinsic value is 100 rupees, but the market price is sitting at just 70, the company essentially gains 30 rupees per share just by buying it back. The value is actively created for whoever is left holding the bag, in a very good way. But flip it around. If they buy at 130, well, they just overpaid and value is instantly destroyed. It really is that simple.
Moving right along to part 2, the financial math. Now, as Neha from our CFA Roundtable brilliantly pointed out, earnings per share can actually increase even if the company's net income hasn't grown by a single rupee. Look at the math here. Let's say we start with a net income of 1,000 rupees and 100 shares. That gives us an EPS of 10, right? But if the company buys back 20 shares, our denominator simply drops to 80. Suddenly, boom, our EPS jumps to 12.5. The company didn't make a single extra penny in profit, yet the metric looks absolutely fantastic.
And that brings us to the trap. This phenomenon is textbook financial engineering, and examiners absolutely love to test you on it. It looks incredible on paper to see that EPS climbing, but as an analyst, you have to dig deeper. You have to ask yourself, is the underlying business actually growing, or are they just shrinking the denominator to create an illusion of growth?
Because the impacts go way beyond just EPS. You've got to realize that using cash to buy back shares directly drops your shareholders' equity, which automatically inflates your return on equity. Your ROE looks amazing, but what if management actually borrows money to fund this buyback? Well, debt goes up, equity goes down, and your leverage ratio completely spikes. That translates to significantly higher financial risk for the business.
So what's the broader market takeaway? Analyst Kabir puts it perfectly. Buybacks are like a giant megaphone. They signal one of two things to the market. Either, hey, our stock is super cheap and our future cash flows are rock solid, or it's a desperate whisper saying, we have absolutely no idea how to grow this business, so we're just going to prop up our stock price. Decoding that signal is your job.
Let's move to part 3, real-world cases. Let's see how this actually plays out in the real world. Compare Apple to IBM. Apple used its massive organic free cash flow to buy back shares, accelerating their EPS while the underlying business was still firing on all cylinders. That is genuine value creation right there. But IBM? They spent heavily on buybacks while their core revenue growth was completely stagnant. EPS went up artificially, sure, but the stock ultimately underperformed. EPS growth does not automatically equal business growth.
Then you have Meta Platforms. They brilliantly used a strategic buyback during a massive market downturn. It was such a bold statement. Management basically stepped in and said, we believe our stock is vastly undervalued right now. And guess what? The market immediately rewarded that massive confidence signal.
All right, section 4, dividends and risks.
So why choose buybacks over regular cash dividends? It usually comes down to flexibility and taxes. Companies can start or stop a buyback program on a dime, but cutting a cash dividend, that is usually a complete disaster for a stock's price. Plus, dividends are often taxed immediately as income, whereas buybacks are way more tax efficient for long-term investors. And obviously, only buybacks give you that direct mathematical EPS boost we just talked about.
But you absolutely have to watch out for the dark side. Are executives just doing this to hit their EPS targets and cash in their own bonuses? What about timing risk? Are they literally buying at the absolute market peak? And let's not forget opportunity cost. That cash could have funded a massive new product line or acquired a major competitor. You cannot ignore what they're giving up to buy those shares.
Okay, finally, Section 5, Pro Tips and Practice. Let's get you ready for the exam. Our senior CFA host stressed this above all else. Always connect the numerical logic back to economic reality. Is real shareholder value actually being created? Focus on that, not just the EPS metric. And hey, a quick pro tip for your study prep. Lean into AI. Using modern AI capabilities to instantly generate dynamic practice scenarios or to quickly calculate how complex share adjustments impact your valuation models is a total game changer. It'll save you hours. Also, keep your eyes peeled for exam keywords like mispriced and capital allocation.
Okay, let's put this into practice. I highly encourage you to pause the explainer right here and test yourself. Question 1. A company repurchases shares at a price below intrinsic value. What is the most likely result? Is it A, B, C, or D?
All right, if you remembered Almond's core principle from the very beginning, you nailed this one. The answer is C, value creation. By buying back shares for less than they are mathematically worth, the company is basically acquiring its own assets at a massive discount. That's a net gain for everyone still holding the stock.
Let's try another one. This focuses on that critical risk we discussed earlier. If a company funds buybacks using debt, what actually happens? A, B, C, or D?
The answer is C, financial risk increases. Think about the pure mechanics of it. You are piling on debt while simultaneously shrinking your equity base. Your debt-to-equity ratio completely shoots up, and your overall financial risk surges right along with it.
Okay, last one. This is the ultimate conceptual trap that catches so many candidates off guard. EPS increases after a buyback. This necessarily means what? Read the options carefully.
And the answer is C, shares decreased. An EPS increase absolutely does not guarantee the company is more profitable or that value is genuinely created. The only absolute undeniable certainty here is that the denominator shrank. The math shifted. That's why we always have to look deeper than surface-level metrics.
Which leads perfectly into this final takeaway from Kabir. A buyback is only as good as the decision behind it. It's just a tool. It can be used masterfully to create immense wealth or used poorly to mask underlying business failures. So what kind of signal is your favorite company sending with its capital allocation? I want you to think about that the next time you see a headline about a massive share repurchase. Keep thinking like a true analyst, and I'll catch you in the next explainer.